Hello, I will be doing the Session 10 assignment today. And so let's just get straight to it. The assignment overview is evaluate Starbucks' proposed flagship roastery that requires a $12 million upfront outlay and is expected to operate for 10 years. Use the firm's 8.5% WACC as the hurdle rate to determine whether the project creates value and to recommend an accept/reject decision supported by driver documentation. So the parameters for the project is there's an initial investment of $12 million, which accounts for the building, equipment, training, and depreciated straight line over 10 years. The working capital is $500,000 and it's deployed at launch and recovered in 10th year. The revenues is $8 million in year one, $11 million in years two through five, and $9 million in years six through 10. And the operating cost is 40% of revenue. Labor is $2.5 million. The rent and utilities make up 0.8 million. Marketing is 0.3 million in year one, then 0.1 million thereafter. The tax is 25% is a 25% corporate rate and a determined value of $3 million at the end of the 10th year. Okay, so put into Gemini and then this says the following parameters are extracted from the assignment briefing will be inputs for the model. So the hurdle rate is 8.5%, and this is used as the discount rate for all metrics. The initial investment is $12 million, year zero, year zero outlay for building, equipment, and training. The project life is 10 years, and it's a period over which cash flows are projected. The depreciation method is a straight line and it's over 10 years with the annual depreciation that equals $2 million divided by 10, which is $1 million and 200, a million and 200. Yeah. And then the net working capital is 500,000 and deployed in year zero and fully recovered in year 10. The corporate tax rate is 25%. It's used to calculate taxes and depreciation tax shields. Terminal value is 3 million. Expected sale value, liquidation value at end of year 10. And so we can take a look at the revenue and operating cost projections. So in year one, the revenue is 8 million. COGS is 3,200,000. The labor is two million 500. The rent utility is 800,000. And the marketing is 300,000. Years two through five would be a revenue of 11 million. COG of 4,400,000. The labor would be two million 500,000. Um, the utilities would be 800,000 and the marketing would be 100,000 in years 6 through 10 would be 9 million, 3 million and 600,000, 2 million and 500,000, 800,000, and 100,000. The project should be accepted if its net present value is greater than zero. The WACC of 8.5% is the minimum acceptable rate of return. And so this is the incremental cash flow schedule logic. You can see the formula right here, the annual operating cash flow formula, the OCF formula, excuse me, that's the operating cash flow. And this is the total cash flow in a year calculation. And we can see that year 10, an additional terminal value component is added. The NWC is a recovery and cash flow. The core capital budgeting metrics formula, this is the net present value formula that we was used, the internal rate of return that was used, the profitability index, payback period, sensitive analysis plan. The revenue shock, which would be revenue times 1 minus 20%. The WACC stress would be WACC plus or minus 2%. And this is one of the Python code parameter assumptions, the WACC right here, the tax rate, the project life, the investment and depreciation. You can see the working capital, the revenue schedule, cost schedule. The Python implementation will iterate from year 1 to 10 to calculate the operating cash flow, OCF, then combine it with investment and then terminal value components to get the total cash flow array for years 0 through 10. So this is the year counts. This year 0, year 1, year 5, year 10. And it's the 8 million, 11 million, 9 million revenue, the 6.8 million, 7.4, 1.8, 0 to 2.4 to 0.4, tax rate, NOPAT, depreciation, it's the total cost, total cash flow. In year 0 was negative. 12.5 million. And then the year one is 1.2 million. Year five is 3 million. And year 10 is 5 million. The sample calculation for year five is revenue of 11 million. COGs are times 0.40, 4,400,000. And the other costs are 3,400,000. The total OPEX is 7,800,000. Depreciation is 1,200,000. The EBIT is 2 million. Tax is 500,000. The notepad is 1,500,000. OCF is 2,700,000. Total cash flow, which would be this right here. And that's basically it. And this is the other code that was in collab. So here's the Starbucks rostery, capital budgeting, the methods. This the initial investment, working capital, the life years, WHCC tax rate, terminal value, revenues, COGs, labor, rent, utilities, marketing year one, and the other years. So there's timeline, the year, depreciation, metrics, profitability index is right here. The baseline model, the output, and then you get to the summary, and yeah.